So Uber is up 16% today. We're going to talk about earnings. We're going to go over what I think the company is valued at, where I would be buying it for the long term, and ultimately if this is going to be one of the bigger mistakes in my investing career by not getting back into Uber. In my investing career over the past 8 years, there's been like 5 or 6 grand slam home runs. The first one was buying Tesla pre-split at like $210, which is just insane. That would be like 40 something bucks right now. I was buying Moderna at $11. I was buying Carvana at $14. If I would have sold at the super highs, that'd be insane. I was buying Shopify pre-split at $100. That'd be like $10 now. And Neo, I was buying it at $1.92. And Uber, I was buying it like $12 or $13 in the pandemic, which I sold all of those for a ton of cash. But I've always thought about potentially getting back into Uber. I like the company long term. We're going to go over the numbers, but the main reason I didn't pull the trigger on Uber recently when we were back down around 20 bucks is just because of the economic landscape in general. Looking at how everything is right now, I don't want to be long-term investing in any company that's burning cash. Just honestly, unless Uber's down at like 13 bucks or whatever again. That it was lows during the pandemic. So that's when I was buying it last time. It was like 14.50 or 14.80. But if you've been following this channel for the 2 years it's been around, that's really what I made my first videos on, was my buying Uber during the pandemic. But we're going to go through it. We're going to talk about it. If you guys haven't already, check out our Discord community, completely free. The link is in the description. You guys get access to free courses, free live streams, free seminars, free webinars. Come hang out in the long-term chat. Asked a lot of you guys yesterday what companies you want me to go over. We have Ford coming out today, Shopify coming out today, and then we have earnings as well tonight for AMD, PayPal, SoFi, Airbnb, Starbucks, and then I'm going to recap Pins, Activision, and Simon Property. So a lot of videos coming out on this channel over the next couple of days. Let's talk about Ubers. So Uber reports another big loss, but beats on revenue. Shares pop 14%. Uber reported a net loss of $2.6 billion for the second quarter, 1.7 billion of which was attributed to investments and revaluation of its stake in Aura, Grab, and Zomato. Uber beat their analysts' estimates for revenue, and CEO Dara Khosrowshahi said that Uber continues to benefit from an increase on in-demand transportation and a shift in spending from retails to services. Now, if you're investing in Uber, like, you already understand the company burns a lot of money, but if you remember, right before the pandemic happened, Dara was saying that it seemed like they could be profitable later that year. And now, of course, while they did benefit very greatly from Uber Eats during the pandemic, we saw the actual rideshare aspect of the company not do very well. And so in a post-pandemic world right now, we're trying to figure out where the company's going to be. How many people are going to go back to using their platform for, their ride sharing aspect, because a lot of people were worried that would be hurt because everyone's still working from home even after the post pandemic, and also how many people would stick with Uber Eats, etc. Uber reported a second quarter loss on Tuesday, which beat analyst estimates for revenue and posted $382 million in free cash flow for the first time ever. That is massive. So the actual numbers. Key metrics: loss of $100 per share, not comparable to estimates, and revenue was $8.07 billion versus $7.39 billion that was originally estimated according to Refinitiv. The company reported a loss of $2.6 billion for its second quarter, 1.7 billion of which was attributed to the investments and reevaluation of stakes in other companies. So yes, that's a huge loss, but really half of that, a little more than half of that, was actually not them, but the investments that the company ended up making. Dara did say that in prepared statement that Uber continues to benefit from an increase in on-demand transportation and a shift from spending from retail to services. The company reported adjusted EBITDA of $364 million, ahead of the $240 million to $270 million, so a massive beat that it provided in the first quarter. Gross bookings, which is a huge number that we look for, is 29.1 billion and was up 33% year over year and in line with its forecast of 28.5 billion. So those numbers are freaking massive. This company is growing very, very fast. Now, Mobility, so gross bookings 13.4 billion, up 57% a year ago. Delivery gross bookings 13.9 billion, up 12% a year ago. So their mobility bookings are up 57%, which is really good, but it's not that insane considering that like a lot of people weren't out traveling, using Uber couple of, but this time last year. But the fact that their mobility is up 57% and the delivery is up 12% year over year, when last year was their craziest year for, Uber Eats, that's really, really, really good. And that's why even though they have that massive loss, the stock is still up huge, Uber relied heavily on growth in Eats delivery during the pandemic. We already said that. The trend continued during the second quarter, and its mobility reported 3.5 billion. So we don't need to go over this. We already talked about this. So really, really good for the company. Now let's talk about the valuation. So Morningstar, a couple of other companies have their fair value based around $73. So at this point, trading at $24 even right now to most of these companies is like a 5-star price. When I look at the company, I really like them. I really do. I think that they will be profitable in the next 3 or 4 years. They've spent a lot of money to do what they've been able to do, but their growth is absolutely nuts. And for me, if the economy was the way that it was like 4 years ago and they were growing at this nuts rate, it would be a no-brainer in my opinion. But the fact that the company is burning money is something that does worry me. If we look at just a brief financial overlook of the company, revenue growth is just disgusting, right? 2019, 2020, 2021, you're looking at 14 billion in 2019, 11 billion in 2020, 17 billion in 2021, trailing 12 months, 21.41 million. 2021 to the trailing 12 months is insane growth. So overall, really good. And if you look at operating income is getting much better, right? Still a loss, but getting much better. And that's what you want to see. When you see revenue climbing and operating income losses becoming significantly better, that is where we're getting to this point where this is really, really good. Because imagine if next year they can do 25 billion and a loss of 1 billion, which think about it this way, is one thing I do want to state. If they didn't have those losses from their investments in those other companies, they'd only have a loss of 1 billion. It's a lot. I can't believe I'm saying it like it's not a lot, but they would only have a loss of $1 billion for that time, which is really good. So let's say next year, for the entire year, it's only a loss of $1 billion, and they can put 23 billion up in revenue. And then the next year they can do 24, 25, or whatever their growth rate is. That's a conservative growth rate for revenue. They could be profitable in 2 years, 3 years, depending on the economy. I'm saying probably 2.5, 3. And we could still see revenues up around 25 billion, 26 billion. Looking at the balance sheet briefly too, you can see here that total assets for the company are growing: 31 billion, 33 billion, 38 billion. Trailing 12 months, so Q1 was 32 bill, but let's just look at last year, 38 billion. Total liabilities are also growing drastically as well, but in order to grow a company, you're going to have to incur a lot of debt, and you're going to have to spend money to grow the company. The biggest issue in which I have right now is just the fact that the company's not profitable. Like that's it. I love the company. I love what they do. I love Dara. I think the leadership team for the company is phenomenal. It's why I invested in the company in the first place. The biggest issue that I really have is that it's just not a profitable company, and it's very, very hard for me to invest in something right now that's just not profitable. If I was going to go out there and invest in a company that wasn't profitable and take a big risk, it would be Uber. I've been standing behind Uber for years and years now, and I think one of the first videos I made was like Uber to $100 by 2025 or something like that. And I think that it's a stretch. I don't know if we can get to that in 3 more years, but there's a big chance. Like I said, if the company becomes profitable in 2 years and they're putting up 28, 27, I mean, their 1 year revenue growth is 92%. It's freaking nuts, right? But the profit margins are bad. So for me, I really love the company. I want to invest in them, but I have to be very diligent about where I buy and what time I buy, which sucks because I love this company. But with the current economic conditions, I can't go just taking a position because I love a company. It has to make it has to make financial sense in order for me to do that. And at this point, it just doesn't. Am I going to miss out on another home run investment? Probably, probably, but I'm okay with sitting out right now. And what I might do is start selling cash secured puts every week on Uber for $20 and just hope I get filled at $20 at some point. But we'll see. Let me know what you guys think. Let me know if you're investing in Uber. I'd love to hear from you guys. Let me know any tickets you want me to go over. And I'll see you next time. Peace.